It's time for Macro Monday, where the city's heartbeat meets the global economy. From Wall Street to the West Side, we track future interest rate moves, credit spreads, and national market shifts that shape New York City real estate. Fast, focused, and data-driven. Macro Monday starts now.
That's fun.
Is it growing on you yet?
I mean, what can I say? It's got some skanky guitar. I like
skanky.
it. What can I say?
Yeah, it is skanky guitar.
Little swampy guitar action.
Hello, everybody. Thank you guys so much for joining us. It is a snowy Monday. I guess everyone's just shoveling out today. We're probably going to be a little slow to start, but we're going to keep on rumbling, guys. That is John Walkup right over there. I am Noah Rosenblatt. We are both with UrbanDigs, and today is Monday. So you're going to get a little Macro Monday coming right at you guys. For those of you that are new to this show, we're going to start out in Manhattan real estate right over here on the left side. I'm going to say right side. For me, it's on the left side. Go over some monthly doings. Johnny, monthly doings. Where are we? Monthly doings. Where should we be? Monthly doings. And then we'll go over a couple of macro charts. We're going to be easy on you guys. We're going to be easy on you guys. We don't have too much crazy stuff today. Okay. Everyone's just slowly getting back.
No, it's a snow day. It's a snow day.
It's a snow day. Exactly. But what I do want is engagement. I really want you guys to talk to us. Tell us what you think as we go from topic to topic. Okay. Some crazy stuff going on in this world right over here. We're going to talk about it. But you know what? All the stuff that we do talk about, none of this is financial advice. Do not start day trading this stuff.
Okay? A bad idea.
Yes. Do not short silver. We told you that last time. Do not short silver. I will not short silver. Somebody needs to send me that, Bart Simpson on the chalkboard. I will not short silver. I will not short silver. I keep hearing that in my head. Trading voice.
It's a lesson that you need to learn.
Okay. Let's get into something more exciting than day trading. I don't think anything can be more exciting than day trading. All right, Manhattan real estate, guys. Let's look right over here. I'm on the market snapshot. This is on the UrbanDigs dashboard right over here. Market snapshot. You guys can do this yourself. Let's go over this together. I clicked on the 1 month market ticker. This is like the CNBC ticker for Manhattan real estate, except it's UrbanDigs, not CNBC. Supply. This is how many listings came on over the last 30 days, guys. You can see these are all the listings right over here. These are all the days, all the listings. 922 over the last 30 days. It still goes back to just the end of December in there. So we got to get all these low things out here and get some big bars coming in, hopefully. That is supposed to end at 1296 for January. We're at 922. It's probably going to be below, I guess.
I mean, that seems like it's been the trend for supply over the last who knows how long. Just low supply. It's just very, very
low.
This kind of how I sum it up.
Tight supply, tight inventory market. That's what's pushing the pulse up higher, generally speaking. It's not demand. See, that's demand, guys. I don't know if you know. That's demand, right? That's market pulse. Market pulse is supply and demand. I don't have supply on this page. So if demand's going down and that's going up, that means supply is what's causing it. Contract signed 630. That is supposed to end January at 778. 778 is our norm for January. I'm hearing, for what it's worth, a lot of anecdotal reports of activity, pipeline activity. So
it's going to be close. I mean, look, we have a snow day today. I don't think there was a lot of open house activity over the weekend. So even if you're planning to kind of work that go out, see something, get the due diligence done, like it's going to be tight. I think we may come in low. This is just spitballing. I think we might come in low for January, but I think we might see a little bit of a bump in February as some of these snow contracts get pushed a little bit.
Snow contracts. If you could just pull your eyes down here, guys, this is the seasonality element that you need to be aware of. I mean, this happens every single year. We typically see our low in contract activity after the whole fall by the end of at the end of the year, each year, December holidays. This is what happened last year. This is what happened the year before that. This is what happened the year before that. And then I want to point your attention to the green boxes. The green boxes is what's happening after those lows for the next couple of months. That's basically our spring seasons. So that's typically what happens. We're probably going to see this start to just go up and hopefully stay up there for a long time. that would be a nice spring season. So we are about to get into it. It's just a little early. It's just a little early. Okay. Right. Watch this. Watch that number. Okay. Okay. Questions, concerns, criticisms?
Quick question. It says, I love when you guys give context on what's normal. Any chance you can add that normal data point on those charts if it's already there? Remind us how we can see it.
Yes, I will show you how you can see it. Go to the chart room on the left. Okay, chart room on the left. Monthly. You could do this for contract activity and supply. It's on our third row down, right? So monthly contract activity. Let me just get away all these price points. Let me generate that chart. If you go to this chart, it's going to show you. See, look, this is that's it. Right? You can take that out. That's the averages right over there. Okay. So if you go 1 year, that's where I got 778 right over there. Okay. That's how you get it. February 951. These are the averages for each month. And then you put that over it, and it's going to tell you whether or not actual production in the industry is above or below the seasonal average. That's how you know, was it a good season, normal season, or slow season? Okay. Very good question. You could do that for supply and chart contract activity.
Thank you, Noah. And then I have an interesting comment from Barbara. She says, lots of open house activity on the weekend. Even yesterday, I stand corrected. A colleague reported 9 parties at an open house on the Upper West Side yesterday and more than that on Saturday. So that's awesome. Congratulations. I hope those 9 people start competing and we get a contract signed on that one at or above the asking price. Yeah. I'm going to blame it on the snow. That's like snow luck. There you go.
Snow. I'm hearing anecdote. I'm hearing some activity out there. I don't know. I'm hearing activity, but you guys are 2-3 weeks ahead of us. We see it when that contract gets signed and this goes up. This goes up. It's liquidity number. Okay. But all eyes are on this liquidity number that will tell us what's going on.
Yeah. It is the time when activity should start picking up. So
yes.
Touch wood and everything, but yeah,
that's why I did the whole thing on the dashboard with the squares and the circles.
I remember that.
Come on, man, get with the program.
This seems like so long ago.
I know, guys. We're gonna pivot. Don't make me do it. I'm not gonna do it. I'm not gonna. We'll save Ross for another time. All right, we're gonna pivot. We're gonna pivot to credit spreads, guys. The macro portion of the program. Credit spreads are, of course, a canary in the coal mine. If this is not going up, there ain't nothing to worry about. In fact, I am seeing these types of charts on my financial Twitter right over here. Corporate bond spreads are the lowest since 2007, guys. That's what's going on, guys. There's nothing going on in the credit market. Just keep on doing it. That allows this crazy risk on mentality in the asset markets. So that's what's going on there.
Yeah, I don't necessarily understand. If you go back to credit spreads for a second, I just want to point out one thing. So we are kind of going sideways. The last little thing was a little teeny tiny tick up, but you could see we've been in this just sideways motion for the longest period of time. And that's basically why these spreads are compressing, because there's really nothing to indicate the other way. There's no fear out there, which means that you're going to keep compressing. But this is kind of boring. Let's talk about stuff that's not boring. Let's talk about the precious metals, because those are going absolutely bonkers. I mean, it's the kind of thing you don't pay attention to, and then you turn your attention to it. You're like, wait, what happened? Gold is over 5,000. What
the heck is going on in the silver market? We talked about this. I know you guys are like, guys, we're Manhattan real estate. I don't know about silver. You know what? But they said the same thing to me when the credit markets were going nuts in 2007-8. And I was like, guys, this means something. I don't know what this means. I don't know what it means. Like, I don't know. Does it mean there's a currency crisis going on over here? Losing confidence in the dollar, central banks? I don't know. But it means something. And we'll probably find out after the fact what it all means. But maybe you guys know what it means. I mean, do you guys have an opinion on this whole thing? I mean, this is crazy. Look at silver.
I mean, you look at silver, like you look at gold. Gold's, I mean, the return on gold, I think Bloomberg had a chart on this earlier. When was it? I saw it earlier. The return on gold from 2000 to today, so this century's basically return is better than the S&P's return of the same period. I think gold's up like 1750. So to me, rising gold prices is like the opposite of confidence. That's kind of how I always took it. So when gold starts going up, it's like, whoa, I don't want to even bother with treasuries. I just want it in something that I can like bury in the sand and then dig out. So that's a little
safe haven type stuff. It could be geopolitical. It could be anti-fiat currency. like anti-paper currency. It could be geopolitical. It could be just safe haven. You know, a really wise trader that mentored me when I was trading back in the day told me gold and kind of silver, they do great before the shit hits the fan. They do great after the shit hits the fan, but they don't do good at all when the shit is hitting the fan, right? So it's like before and after it does good. And you see in this, and the shit didn't hit the fan yet. So this must be the before phase. And that's that guy was a good trader. He was a very
I guess the question I would have on is when you look at a hard asset like precious metals, is real estate in the same class? Are we going to see a similar sort of up to real estate assets? I don't know.
Another person I spoke to said that real estate is after this. That real estate will be the next hyperinflated asset because it's going to go to tangible assets. I don't know if that's going to turn out to be true. What worries me is the deleveraging that might come after this. What worries me is that this will fall way down there and stocks will fall and it'll be a deleveraging period and credit spreads are going to go blow out and go up. And that's just going to cause a risk off period that will trickle down to New York City real estate. Has not happened yet. But like when I see something like this, I'm like, what the heck is going on? And what happens if it goes the other way?
I know. So that's why it's really interesting to sort of look at credit spreads. Oh, by the way, we have a question on credit spreads. What does the orange line in the credit spread represent? I think that's the S&P. That's the S&P's index. So you can overlay the S&P to kind of get a sense
S&P 500.
How they're related. That's it.
They're inverse.
You know, when you look at so when you look at the precious metals going absolutely crazy, and you look at credit spreads going sideways, to me, I feel like there's a missing variable, and I don't know what that is other than like, you know, keep my eye on stuff. What can I tell you?
I have no idea what it means. I really don't, guys. I mean, I don't know. Like, this is a good time for that kind of stuff. We got to be humble, but I don't know. I have a feeling we'll discover later on. There's a lot of things going on right now. The Japanese yen is doing things. There's a big yen carry trade. There's a lot of things that could just disrupt credit markets, but it hasn't happened yet. It's just kind of like percolating. It's weird. It's weird. Anyway, let's go back to real estate, guys. Fed fund futures. Fed fund futures. We're going to do the interest rate portion of the program. This is at the CME Group Fed Watch. You guys could do this yourselves. You don't need me to do it. You can do it yourselves. It updates every day, intraday. What this is, sorry, I'm trying to get this straight, get that top thing off here. What this is the market's expectation on what the Fed is going to do. That's what this is. We are there. Okay, we're there. The next meeting is the 28th, 2 days, right? Wednesday.
Yeah. The meeting just started, comes out, so the decision will be Wednesday.
Okay. So the markets expect by 97% confidence that the Fed's not going to do anything, and we're going to stay in this exact same category. March meeting, 84%, no change. April, 71%, no change. Those are pretty high numbers, guys. And for those of you that know how John and I like to work, we do not want to put you guys into a bad situation where you're telling bad information to people that may come back to hurt you later on. So we're not in the prediction game, guys. We're not in the prediction game. We are in the read the tape game. And you should know from this program that we don't like to go more than a couple of meetings out, right? Anything above this line, all right, we could look at with some confidence, especially when these numbers are high. Confidence. Anything below this line, time is getting too far out. Time is uncertainty, right? More time for things to go wrong, and these numbers are starting to go lower. So be careful. The first cut that I see on this whole thing is in June, and that's not even for certain. 45%, it's not certain. Okay, 40% no cut. See how that works? So how many cuts is the market pricing in for the Fed? One. I mean, the second one is in December, all the way out to December, and that's 32% chance. So I don't know. You're almost at terminal rate here, John.
Yeah, I mean, when I look at this, I see 97% this week. That's a given. And then basically I'm looking down and it's effectively a straight line all the way down. Yes, there's a little bit of a lower rates cycle happening in late 2026 and early 2027. But to me, it's very similar to what we're seeing in the credit spreads, right? Everything's just kind of going sideways and it's just very, very neutral. There's no one's really making a decision one way or the other. And that tells me that I feel like we're waiting for some sort of outside catalyst to really push us either back into a rate cut regime or a rate tightening regime. So is that going to be inflation? Is it going to be unemployment? Is it going to be Japanese bonds? Is it going to be, who knows what it is? So I just feel like right now everything's just sort of waiting. And while it looks good on paper, this neutrality, it does feel like there's a hint of like uncertainty on its shoulders right now, which I feel is kind of could break either way. So I'm cautiously optimistic here, but it's cautious with the capital C.
Yeah. Again, we are, whoops, get that out of there. Sorry guys, give me a second. We are at this level right here. And pretty much this entire thing is between these two things here. Like, I don't even know about this right here. So it's scary how certain this is. And that certainty almost makes me feel uncertain.
Yes, thank you. Like, yeah.
Like, wait a second. This is telling me that rates are not going to move for 2 years? Okay, sure. As somebody pointed out in the comments right over here, let me go to the comment. Rates can change in between based on other events. Exactly, guys. Rates will move every day, and we have no idea what the future is going to hold. But right now, where the Fed is with their rate and where inflation and all this other stuff is, it looks like, barring any other changes, we're at where we're supposed to be. Maybe we get another cut. Guys, it's possible we get that cut. Let me get out of here for a second. It's possible we get this cut right here, and then all this stuff shifts to the right and mortgage rates go up. We talked about that before. That could happen. But in the meantime, mortgage rates, here's mortgage rates, guys. Let's just tell you what you need to know. 1 year mortgage rates. I mean, we've been down in this like new lower section since like September, October, and we're kind of at the lower midpoint of this channel. Mortgage rates are doing just fine. It's not mortgage rates that's impacting our markets.
Yeah, no, in fact, I mean, they touched, I think was it last week, the week before, they actually touched a little bit below 6%. I think we got to like 5.99 or so on the 30-year fixed. I think you could even drag that top yellow line down a little bit, almost to 6.25, because we're in a very, very tight channel here. I mean, I'm hoping this downtrend continues. I don't know how much farther it's got to run, especially when you look at the compression we've already seen in rates. When you look at what the Fed's doing, it's just everything's sort of on neutral here. But that being said, I mean, these rates they're not fantastic. This is certainly not 2002. Like, sure, take some money. It's for free. But historically, these are decent rates. So I'm really, really touching wood, salt over the shoulder, crossing my fingers. I'm doing everything I can to wish this market good luck, that these are transactionally focused rates. And I think they're going to help with the spring season.
That's right. Wasn't it Mark Twain who said, if everyone's going in one direction, don't follow? Yeah, that's why I'm a contrarian. That's what, short silver. Hello. don't short silver. But yeah, I mean, generally speaking, my mentality is just go the other way. People thinking that way, go that way. We'll see. A lot of crazy things going on in this market, Deborah. We're gonna keep every Monday. We'll keep track of it, right? Until you see credit spread, until you see this little index on the top move to the right more than a couple of moves. One move is not a big move. You start to see us go to stage 2.2, 2.3. Then you're going to look at the stock market and probably see that we're down 5-10%, and something may be happening. Until then, risk on. And rates not affecting us. Other forces are, but not rates. Okay. John, you made a really prescient observation about a year ago. I want to give John his due over here. Give John a little, throw Johnny a bone on this one. But around this period right here, I don't think I can draw on this, but right around this period right there when this was high. Guys, this is telling you the spread between the 10-year treasury yield, which a lot of us think is what kind of the mortgage rate is tied to, and it is. What the spread is between the 10-year treasury yield and 30-year mortgage rates. And about a year ago, it was high. It was in this high segment. And John, you said that mortgage rates could compress. We could go down in mortgage rates, even with the Fed barely cutting rates. And that's exactly how it played out, guys. And this has come down, and we're now in a historically more normal level. So when you see mortgage rates coming down, it was a lot had to do with this and less had to do with the actual Fed moving rates. Great.
Yeah. And so, I mean, we're in the historical section now. So, I mean, the question is, how much lower can that go and still be sort of valid in terms of the history? So we're sort of in the range right now where if it stopped going down, it's still okay in terms of the historical level. So if we're in that yellow section up there, that's when I get the idea like, all right, we still have more to go. Right now, we might not have more to go. And especially if you've got the Fed going sideways, you've got threats of inflation on the horizon. Again, you're in this level of uncertainty, in which that narrative of that lowering narrative is sort of stopped. So we might see rates basically hover sideways from here. I would love to see them tick down a little bit, maybe go to like 598. But right now,
Right.
again, this is the conforming. But right here, right now, I almost get the sense that we're sort of just almost at the end of this road.
I'm very Sammy Hagar of you with the right here, right now. That I agree with. This is another logic, a piece of puzzle in the thesis. Did you catch that?
I did. It took me a second. As you saw the little.
Gotta be quick.
The gerbil in the wheel.
What the hell is he talking about? No, but this is another piece in the puzzle of to why we think rates might kind of stay where it is. This and this is both telling us that rates may not, move that much. That it might just be kind of in a stability zone for a period of time. Again, that ekes of uncertainty to me because nothing's ever stable in these markets. But until something happens in the future, guys, and then the credit markets determine if that's a problem, that's a good way of looking at it. You wake up one day, something's happening, stock market's going down, look at the credit markets. Are the credit markets buying into this, or they're like, something bad's happening here? They'll tell you whether or not that's going to follow through or not. Okay, guys? Okay. Right now, I don't see it. Okay, compression, mortgage spread down. Let's just do a couple of national housing charts. We are a macro program after all. Just go outside of our Manhattan bubble just for about 2 minutes, guys. So you're aware of what's going on in the country. It is not just us. Pending home sales, this is across the country. Pending home sales, deal activity, contracts that were signed, et cetera, et cetera. 2025 was a record low for the nation. And that's the fourth year of it, right? We've been in our own slump for a little bit of a while, but we're like 3 years. We're about 3 years into our little volume trap thing. The national housing market's in their fourth year. So that's what's going on over there. Okay.
Yeah. And I don't see any real recovery on that until you have, there has to be an answer to the affordability question. And I think that's why you saw those record numbers in 2020, 2021, because mortgage rates were so low, it made affordability a lot easier. Now we're in this range where 6% mortgages, even at 6%, you're not at the place where the money is just free anymore, and the home price makes sense because the loan is super cheap. So I'd like to see a recovery in that, given where mortgage rates are now, and I think 4 years is a enough period of time where you've probably got a nice number of buyers on the sidelines and sellers too. Similar to here, I feel like in Manhattan, we got plenty of buyers on the sidelines, just kind of waiting to take advantage of stuff. I mean, Scott mentioned his phone was ringing off the hook this weekend. So I'm hoping this all comes together this season, because I feel like
me too.
It's been close, but we just haven't got there yet.
Yeah, we'll keep an eye on that on all of our Friday reports. But the action outside of our market, guys, in national is not existing home sales. The volume, okay, this is a volume chart, sales volume. The volume's is in new home construction. That's what's going on, because the new home construction guys, they could lower their prices more easily. They could do buy down on interest rates. That's where the action is, not existing home sales market. So that's what's going on.
I mean, just a little. This is a little bit of a chart voodoo. You're really kind of not supposed to do this, but they're mixing axes. So the red line, the number on the red line is 780K, and then on the blue line it's like 4.2 million. So these are totally different scales here, but we're sort of mixing them. But to your point, Noah, that's
two nulls. Look at that, increasing. 2 nulls right over there. Look at that, 2 nulls do not make a right. See on the bottom right there?
No, that's right.
You should contact these Reventure guys and tell them how it's done.
No, it's just the question is you want to see the movement. So they're trying to show the movement, but you just got it. When you see the double axis, you got to don't lie it.
I'm not going against Johnny Charts. That's for sure. And let's circle back to Manhattan real estate, guys. Circle back to Manhattan real estate. This is less about me giving you information and more about me showing you how to use this section. We're in the chart room right over here, guys. We're at liquidity pace chart. And I went ahead and I loaded up my price range. You guys could do this also in case you didn't know. Every once in a while, John and I like to look at the different main price sectors over here and look at deal activity and see if there's anything that's worth noting about, writing a story about, talking about, a Forbes article, whatever it is. And when I do this, I like to look at the year over year. Okay, guys, the year over year, because the month over month is going to be very seasonal. So the one thing I notice when I look at the price points is that the 1 and 2 million sector is actually the only one showing growth at this point from last year. Every other ones are down. So
Yeah, and that's a very precarious position to be in because the luxury market had really been powering this entire thing for the last few years, right? You think back to that national housing chart we just saw and how all those levels were compressed. That's what basically we're seeing in the sub-luxury market here. But now it's actually starting to tick up. It's not a lot. I mean, we're coming off a low level, but still, it is the bulk of the market starting to tick up. That's a good sign in terms of just for us as brokers, we want that transaction volume. So starting to see some transaction volume there, but I'm hoping this market can do like a little bit of flojo action, right? Hand off the baton from the luxury to the non-luxury as those mortgage rates compress, get around 6%, start to get some traction there. I do think the luxury market will probably kick back into gear in the spring. I think we're going to have a pretty phenomenal bonus season. I think we have some cash on hand to spend on some units. But again, it's you do want to see that sub-luxury market kicking into gear, and I think we're starting to just get some green shoots that indicates it might be back.
Yeah, and I just want to, again, it's less the information I'm giving you guys. It's more about this is how you do it, right? This is where you're going to measure your liquidity. If you guys are having conversations with sellers about the state of the market, the temperature of the market, I know a lot of us only focus on price and then our marketing plan and everything we're going to do and all that kind of stuff. But try to tell them these two, right? The climate index and the liquidity pace chart. Try to go granular. First, you go granular, guys, like the Chelsea 1 to 2 million resale condo market or whatever it is. Take a look at the chart. See if it's worth reviewing. See if the chart makes sense. If it's too granular and there's no data, the chart will be really all over the place, missing bars. Then you can go wider out. And see if you can get a trend. But taking a look at demand, where is deal activity? Taking a look at the temperature of the listing climate. What's the temperature of the climate? Easy, challenging, neutral is going to give sellers two things that they typically don't ever get. And that may save them from making a bad decision, like pricing too high. Okay. Or not doing their first price reduction when they should.
Yeah. Well, thank you. So let me just put on my shameless plug hat. I will talk about how pricing too high is probably the worst mistake you can make. I mean, it's just, you'll sit on the market forever. You'll take a massive penalty. So shameless plug, if you've got something that's tricky to price, give us a call. UrbanDigs Advisor, we do a deep dive and we help you understand how buyers are going to be viewing that today to help you avoid that mistake. It's one of the services we offer. So shameless plug over.
Thank you, John. This is a good chart to show that penalty, guys. That's why it's there. Pricing. These charts. You guys asked us to build these charts so you can have these conversations. A lot of you guys don't know it's there. It's a great weapon. So take a look at that. These are three great charts: pricing, penalty, liquidity, and climate index. Okay.
I got to throw this up. Dale says, "Price it too high, watch it die." That's fantastic. I can't believe I didn't figure out that rhyme, but I love it. So thank you, Dale. That's good stuff.
Yeah, absolutely. And you missed that. How are you supposed to create any urgency when you're pricing too high aspirationally in a challenging listing climate, right? I mean, it's just not the way to go. And that's basically it, guys. That's all I have for you for today. I mean, I don't want to overload you with charts with the snow. There's one thing I'll point out. Thursday, we have our great Phil Horrigan. We do the roundtable market update. Always a lively conversation. Nikki will be there. I think Nikki's here as well. A whole bunch of other top agents are going to be there. Tomorrow, in case you're around, valuing outdoor space. That'll be me and Johnny. We'll talk about the Jonathan Miller method. We'll talk about the UrbanDigs method. You got a balcony, you got a small terrace, you got a large terrace. What the hell do I do? How do I price this thing? We'll talk it out. 30 minutes, 11 o'clock. Outside of that,
good stuff.
We done.
Thanks, everybody. Appreciate
That's it. John, any last final thoughts?
That's it. Let me see. Let me check the comments. Good one here. Would you say, or when would you say is the best time to get a listing up this season now, or wait until after President's Day? That's a great
Go to the chart room. Optimal time to list. We talk about this all the time. If you're gonna strategically time your listing, that means that your client has the luxury of time. They don't have to put it on the second, and they're literally asking you, when is a good time? Guys, that's what this chart is for. This is telling you average deal activity by month, by calendar month of the year. Okay, so every month has X amount of average contracts. March, April, May, June. That's your top 4. So you want to list right ahead of that. March 1st, right? Very, very, very end of February. Not only that, you start March 1st, and then April 1st is your first price reduction conversation. May 15th is your second price conversation. Why? Because if you don't hear the market doing what the market should do in a great market, March is your best month, then the market's telling you your price is wrong and you need an adjustment. So
right, so you still have time to do it. Although Hillary brings up an interesting point. She basically says it's better to be in a small C so you get noticed. So list when everyone says don't list.
You could do that too, but just the deal
disagree.
activity level might be a little lower. Just keep that in the back of your mind. Okay, but yes, the inventory is tight right now, so that's a sell side leverage. Okay.
Yeah.
Okay. Good question. Any other questions?
That's it.
No.
I don't see any.
Okay, guys. Thank you guys very, very much. Good luck out there. We'll see you guys hopefully tomorrow. Until then, bid you adieu. Take care, everybody.
Thanks, everybody.